Hello, everyone, and welcome back to the J22 Report. I am your host, Johnny Market. You all know that drill. Hit that like button and subscribe if you already haven't. Yeah, this weekend I plan on doing a couple of videos. Hopefully, I can do a couple more. But anyway, just want to do a little disclaimer. Nothing I talk about should be construed as investment advice. It's just my opinions and thoughts on the markets. You can read further more on the disclaimer. And I have two disclaimers actually, so read those and let's get into it. I've had a lot of work and whatnot, so I wanted to get in uh, everything I wanted to talk about. So hopefully this won't be too long. So let's look at it starting Monday. The CB leading index, as you can see, down 6%, much lower than the 3%. So that means the leading economics indicator showing the leading. I don't know how much that is because it's been leading for 2 years, but it shows a bad recession's eventually coming because it's been negative for 2 straight years. So these are the leading indicators. Looking at Tuesday's data is nothing burger, nothing really like to talk about. Mortgage rates, those are down 6 to 6.5%. I do think there'll be some sort of refi boom, or there'll be refi boom, or some people that need a house that they'll start buying. That was my thoughts, but nothing really changing. Of course, the big thing was the FOMC minutes where they talked about rate cutting. If you look at the Chicago Fed National Activity Index, that positive number was an anomaly, as you can see. Well, you can see the national activity number that's down 0.34. Jobless claims, which is actually initial, is more than expected. Nothing too much, but if you look at the S&P Global Composite PMI 54.1, this is where the government spending is going to really help this. And I was looking at the existing home sales here. That was higher than expected, 3.95. But the Kansas City Fed composite -3. So that's, as you can see, this data is not good to mix. Building permits 1.4 up over, here it is, -3.3% month over month. So previous was 145, so that's not good. New home sales were up. I think these were more anomalies. They've been down so much, 7.39. And so you can see why they're cutting rates. This data is not good. It's mixed, especially Chicago Fed national activity. And this is what I said, after the summer, even though this is the summer, the economic data is going to start declining. And I think you'll see it more and more. Uh, and then this is one thing that caught my eye. This was on Monday. Existing home sales rise 6%. Lowest level for July though since 2012, and that's why the data that I just showed you existing is all, it's just seasonal. It's nothing really great. So sales of existing home sales to 4 on a seasonally adjusted. So most of these are seasonally adjusted. It's not because of actual home sales. They said Redfin started tracking since 2012. So this is the worst since 2012, and you can see all the makings of the housing crisis are there. And these figures came as mortgage rates declined. And then here it is. And fell more in August. Home prices, though, remain near record highs, which just goes to show mortgage rates decline. Sales are not good. They're horrible. Even though they're up from the previous month, it's just seasonal. This is the worst July since 2012. And the problem with this is prices. Prices have to come down. And otherwise, we'll see a huge crash. We'll have a crash anyway because so many people have home equity loans. But look at this. When rates finally dropped, buyers got excited and we saw more activity. But now that rates have fallen to the mid-6 range, people have been waiting to see if they drop even more. Home prices are going up though, so it really becomes 1 of 6. they're not waiting, they just can't afford it. Like, that's the thing. They're not waiting to see if they can, there are some people, as I said, buyers, but here's the kicker through all the proper cancellation rates are rising. 59,000 purchase agreements were canceled in July. 15.8% of homes that went under. So who knows? Maybe they might revise this down. That's been the key theme of everything I've talked about. I actually missed that when going over the data. But I've talked about it all week. As you can see, you can just go back to my videos this week. I've talked all about it. While July numbers have been muted, investors see the housing market is turning the corner. Yeah, well, they're dumb. So anyway, you can see many things. Let's go into the last piece of data I want to talk about for this video. Investors price in 4 rate cuts from the Fed Powell after signals ample room to move. So here it is. They are priming the pump because no matter what, talk about inflation, but what matters more to them is asset price inflation. You can't defeat real inflation unless you get asset price inflation. This is why I said when they start cutting rates, there may be a lag when inflation is going to heat up, and it may not even be this year. Inflation may heat up in July, not July, in 2025. So, but here it is. You know, this. I mean, you all know what this says. Do we really have to go over the article? I mean, if you don't know what it says, investors are pricing in 4 rate cuts. Blah 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 blah. Uh, so anyway, that's all it is, and this is what they don't see: is inflation. Once they cut rates, there might be hunky dory for a couple months, but if the economic data looks good, I mean, the real economy has been bad since '08. Uh, so that doesn't matter. But what's going to happen is inflation is going to start to really ramp up to the point where the government will have to admit it. And the only way you can kill the inflation psychology that's entered into the market since 2020 is by cra- hurting asset prices, showing that you're willing to let asset prices fall and you're not going to rescue. That's when inflation will get under control. They're not doing that. They're not willing to do that. And that's why gold, as you can see, went over in last video, starting to outperform the stock market and will continue. This will continue. So anyway, hit that like button, subscribe if you haven't. I'll see you next video.